Good evening, friends. All of you are welcome here in the channel DNA of Tax Laws, where we are discussing various important topics related to tax laws, particularly the income tax and GST. Today, in this video, we are going to discuss jurisprudence of tax laws with reference to New Income Tax Act 2025 as amended by Finance Act 2026, wherein we have to understand, how to interpret, how to read income tax provisions of New Income Tax Act 2025. So, how to interpret the charging provisions, how to interpret the machinery provisions, procedure, etc., how to interpret the exemption provisions. Then we will also discuss how to interpret and what are the internal and external aids. As you know that internal aids are within the statute itself in form of explanation or clarifications or schedules or definition section. As in the New Income Tax Act, there is definition section in section 2, and every chapter ended by interpretation section. Then we will also discuss the external rules of interpretations or external source of interpretations by way of parliamentary committee recommendations or discussion in the parliament debate, like the answer of Ministry of Finance, etc., dictionary meaning or otherwise also. Then we will also discuss the mischief rule of interpretations, and we will also discuss how to interpret the substantive and clarificatory provisions in this new Act 2025 as amended. So, for all these, continue. We will discuss all these in details in few moments. Good evening, friends. Today we are going to discuss one of the important topic, which is jurisprudence of income tax laws and interpretations of income tax law, which is very relevant and important while implementation of the new Income Tax Act. How to understand, how to interpret, how to analyze the new tax law provisions. Although we have history of the old Income Tax Act 1961, but there are so many changes in the Income Tax Act 2025 read with Finance Act 2026. So time to time we need interpretation, and we are trying to how to interpret, how to understand the provisions of income tax law. So in general, we are discussing about the tax, nature of tax or meaning of tax. Then we will discuss interpretation of charging provisions. Then we will discuss interpretation of machinery provisions. Then we will discuss interpretation of exemption provisions. Then we will also discuss aids to interpretation, internal and external aids. Then we will also discuss mischief rule of interpretations, and we will also discuss interpretation to ascertain whether a statute is substantive or clarificatory in nature. So one by one we will discuss all these things. Right. So firstly, the meaning of tax. There is Article 265 in the Constitution of India which give authority to the legislature for levy and collection of tax. So no tax shall be levied or collected except by authority of law, meaning thereby for any collection of tax or levy of tax, there must be law, and importantly, the law must be enacted by competent legislature, and the tax shall be collected. Not only that, tax shall also be levied in accordance with law, and only by authority of law tax could be levied or collected under Indian Constitution. So if we understand the Article 265, then the very important topic is what is tax, nature of tax or meaning of tax. So tax is a compulsory exaction of money by public authority for public purpose enforceable by law, and is not payment for service rendered. In other words, tax is the compulsory exaction of money by public authority, generally the state, and these amounts are collected for public purpose, and under law, competent law, these are collected. So these laws are enforceable by law, and payment for, and this is not payment for any service. So directly we are not providing any service, although we are collecting tax for the development of country or development of a state, but we are not specifically providing any service against the tax collection. So this is different from contract, etc. So in other words, there is the missing element is a quid pro quo, which is the essential element of any contract, which we must understand. So quid pro quo is missing between the taxpayer and the public authority. Another important article 366 clause 28 has defined taxation includes imposition of any tax or impost which is compulsory levy, whether general or local, special, and tax shall be construed accordingly. So tax is a wider term and includes imposts such as compulsory duty, cess, fee, etc. So tax is a wider term. Then power to tax is a sovereign function and legislative in character, essentially required for very existence of government, because a state required fund for development and for security, etc., and tax is the main source of revenue. So power to tax is sovereign function. It must be through legislative function, and there must be a law. Law must be by competent legislative under provision of Constitution of India, and law must be a valid law for levy and collection of tax. So levy of tax to be exercised with constitutional limitation. This is the important point of discussion. Now, earlier days, there was a concept known as regulatory or compensatory tax theory, where under a state could levy and collect tax as a compensation for some service provided or something done for the taxpayer. So this doctrine was pronounced in the judgment of Automobile Transport Rajasthan Limited and others versus State of Rajasthan way back in 1962. 1 SCR 491. Honorable Supreme Court that time has decided this doctrine of compensatory tax theory known as compensatory tax theory, where under the tax levied could hindrance or create some problems or something adverse on freedom of trade, commerce, and intercourse across India. So tax imposed a direct restriction on interstate movement of transport vehicle and therefore unconstitutional in absence of precedent sanction under Article 304 Clause B. But that time the matter went to Supreme Court. Rajasthan Motor Vehicle Taxation Act 1951 establishing that regulatory or compensatory tax for road use so as to keep maintain road and transport infrastructures are facilitative, not restrictive, as decided by Honorable Supreme Court. Therefore, the theory remains in for 40-50 years. Finally, in Jindal Steel Limited versus State of Haryana, these principles or doctrine overruled, wherein Honorable Supreme Court, consisting of 9-member bench, in this case held that constitutional validity of the state entry tax levied by various states, but finally court has decided that no automatic that where a state entry tax infringes Article 301 guarantee of freight, trade, commerce, and intercourse, the court has decided no automatically, but a state may tax on goods imported from other state only if tax is non-discriminatory in nature and complying the conditions of Article 304 Clause A. So it must be reasonable and in public interest. That is important point. Then another question court has answered in Jindal Steel Limited case, whether such tax can be justified as compensatory or must satisfy Article 304 Clause B conditions of reasonableness and presential essence is required. Court has answered in yes, surely we have to satisfy Article 304 Clause B for any entry tax like things. Then a third question court has answered about doctrine of compulsory taxation remained a valid constitutional law. Answer is no. Earlier jurisprudence treating compulsory tax as outside Article 301 ambit was erroneous, as decided in Jindal Steel Limited versus State of Haryana in 2016. It is important landmark judgments, and these judgments has overruled the exclusion from Article 301 known as compensatory tax theory. So we have just explained this theory. Then we must understand the nature of tax, cess, fee, surcharge, etc. Tax has no element of quid pro quo. So essentially, which is the essential element in case of any contract, but since tax is a compulsory extraction of money from taxpayer without any direct service element to the taxpayer, so this element quid pro quo is missing in tax. Fee is certainly for some special benefits or privileges that we must understand. Then surcharge is additional tax levied on the amount of income tax, not directly on income, but is it a tax on tax. And we must have to comply with Article 271 of the Constitution of India related to that. So surcharge levied as per Article 271 of the Constitution of India, it is a tax on tax, not a tax on income, and the nature of surcharge is same as the main tax. So if surcharge is additional tax under income tax, so surcharge is also in the nature of income tax. Then last concept is the cess. Cess is a special type of tax imposed by government for a specific purpose, so like health and education cess, or earlier we have known as compensation cess under GST. So we have just understand all these important concepts. Then is there any distinction between direct tax and indirect tax? We must understand, being a tax practitioner or being a tax student, we must know the difference. Is there any difference in direct tax and indirect tax? So there are broadly two aspects. One, economics to version. Burden of tax by SSC or taxpayer in case of direct tax. So in the case of direct tax, the person who is paying tax or the person who is subject to charge of tax cannot shift burden to some other person. Whereas in the case of indirect tax, burden could be shifted to the customers. Means in other words, in the indirect tax, tax are being collected from the customers and deposited to the government. So the person on whom it is levied or charged is not bearing the tax element. This is the version of economics. But under constitution and tax statutes, there is no difference in direct tax and indirect tax. In both the cases, tax is liability on some persons, whether it is a GST or income tax. So that person is or taxpayer is under obligation, or SSC is under obligation to discharge the tax liability. Even in the case of GST or other indirect tax, there is a levy on a particular person, or we can say precisely a taxable person who is under obligation to pay GST. It is not important whether he could collect tax from customers or he is not in a position to collect tax from customers. So if we differentiate the economics version and constitution or a tax statute, then there is a wide difference. For economics, there is difference of direct tax and indirect tax, whereas in the constitution and tax statute, there is not much difference. But GST or indirect tax has some provisions where generally under contract, they could shift the burden through charging the tax on invoice issued by a registered taxable person, and they could collect tax and accordingly he could deposit. But we cannot take a plea that we are unable to collect tax from customers and accordingly we could not deposit GST. This is not a valid argument. So therefore, under constitution, there is not much difference in direct and indirect tax. This is the important aspect we have just discussed about this. So landmark judgment related to this is the Rashtriya Ispat Nigam Limited versus Diwan Chand Ram Sharan 2012 judgment of Honorable Supreme Court in para 39. In that context, levy of service tax held that provision concerning service tax are relevant only between the SSC under the statute and the tax authority. The statutory provision can be of no relevance to determine the right and liability between the parties, that is the customers and the tax SSC. So this is important point, we must take note thereof. Then there are certain provisions under tax laws where we are not in a position to collect indirect tax such as GST, particularly in the case of composition scheme. If you are registered under a composition scheme, you could not collect tax from customers. So all these are important points we have just discussed. Then another and most important aspect is the fixation of liability, whether it is prospective or there may be situation of some retrospective taxation. Means the applicability of a particular law fixing the tax liability from a date anterior or prior to the enactment of law. So first time the court in the case of Jawaharlal versus State of Rajasthan reiterated that it is well recognized that power to legislate include power to legislate prospectively as well as retrospectively. In other words, the legislature is fully empowered to levy and collect tax prospectively as well as retrospectively. General principle related to respective legislation in tax matters, limitation on power to enact retrospective legislation, and effect of Validation Act we will discuss shortly. So, general principle of retrospective legislation in tax matters were decided in a leading judgment, CIT versus Vatica Township Private Limited 2015 1 SEC 1. Unless contrary intention appears, a legislation is presumed not to intended to have retrospective operation. So by default, unless it is specifically intended and mentioned in the law that a particular law or amendment shall have retrospective effect, the law, any enactment or any new law must have effectiveness only prospectively, not retrospectively. The idea behind that the rule is that current law should govern the current activities because law is by and large to govern conduct of humans. So a law which is known to public could certainly govern the conduct of people, and a law which is made made effective from a back date or retrospective date, then there is difficult to make compliance thereof. So the basic and fundamental principle of any tax legislation or any other law is also current law should govern the current activities. That is very important, and which is known as the principle known as lex prospicit non respisit. Law looks forward, not backward. That we must take care of. So legislation which modify accrued right or which impose obligation or impose new duties or attract new disability have to be treated as prospectively unless legislative intent is clear to give enactment at retrospective effect or legislation for the purpose of supplying obvious omissions or in a formal legislation or explain a formal legislation generally known as clarificatory amendments or declaratory amendments. We know that. So that point was decided in CIT versus Vatica Township Private Limited, one of the landmark judgment of Honorable Apex Court. Now we also note the subordinate legislation. Generally, subordinate legislation must be prospective in nature, but if the main law or the principal act has a provision where we can delegate legislation and that too retrospectively, then delegated legislation could also be retrospectively. But generally, delegated legislation or subordinate legislation must have prospective effect only. Then one of the important judgment, in absence of a specific conferment of power to legislate retrospectively, the government as a delegate cannot exercise authority for retrospective amendment or make any notification issued retrospective effect. So that is important point. Now we have to understand the machinery provision of taxing statutes. So the important point is that machinery provision of a taxing statute has to give effect to its manifest purpose, but applicability of machinery provision, whether it is prospective or retrospective, depend on the content and nature of a statutory scheme. It was decided in landmark judgment of CIT versus SR Technology Limited, again recent judgment of 2018 of our Apex Court. Then we are trying to explain the Validating Act. So Validating Act are generally enacted to nullify the effect of judicial decisions. We are aware of that so many judgments of high courts and few judgments of Apex Court also nullified by way of amendments in the tax laws and providing the retrospective effect there too. So power to pass validating laws with retrospective effect recognized by court time to time. It was reiterated by Apex Court in the case of Eurotax Industries and Exports Limited versus the state of Maharashtra. So legislature is fully empowered to make any retrospective amendment to for causa omissions or any omission made in the tax laws or for any declaratory law or clarificatory in nature. So this is permissible and must taken care of. Now, limitation or on retrospective legislation, it is the important point. So retrospective legislation not permissible to create an offense retrospectively within constitutional and legislative limitations. So retrospective legislation must be within constitutional limitations and legislative limitations as well. Such retrospective law not in conflict with other provision of the constitution or any other law. A reasonableness of restrictions must be there. Then retrospective law is discriminatory or so unreasonable or confiscatory, then it violates provision of Article 14 and 19 of the Constitution of India. Accordingly, it may be declared as ultra vires or invalid law. So we must taken care of the retrospective legislation or any amendment in the statute retrospectively. Then one of the important and controversial topic known as tax planning versus tax evasion versus tax avoidance. We must take note thereof. Tax planning is legal. One of the landmark judgment, G.R.G. Rao Cotton Mills Limited versus CIT. Way back in 1959, Supreme Court has decided that every person is entitled to arrange his affairs so as to avoid taxation, but arrangement must be real and genuine, and it should not be a sham or make-believe transaction. Then another judgment, morality in taxation has no role. In fact, in law also, in general law also, morality has no law. Law is those which is enacted by a competent legislature. So whatever enacted by competent legislature is a valid law. Morality has no role in any tax or any other laws. So one of the main judgments is in the case of A. Raman and Company, 1968 Apex Court has decided and observed that avoidance of tax liability by arranging commercial affairs that charge of tax is disturbed is not prohibited. So suppose we have decided to not to make our sales, we have retained our closing stock, although we are having order from the customer. It is the decision of businessman. So accordingly, we can manage our taxes, we can manage our business. A taxpayer may resort to device to divert the income before it accrue or arise to him. So the most important point is that before accrual or income arise or income received, you can manage or plan your taxes. After accrual, the income already arises or accrued, then there is no remedy or nothing. So we have to deposit tax, and we cannot do such things. So before accrual or arisal, certainly we can make a tax planning like things, which is valid in law. Then one of the another judgment, McDowell Company Limited versus CTO 1985, has changed some perspective of thinking about tax planning. So tax planning should not be any colorable device, or should not be to avoid tax through a colorable device. Otherwise, planning is within corners of tax statutes and not supported by any colorable device, that is a valid tax planning. There is no harm and nothing wrong in that. So because everyone is free to manage their affairs or plan their affairs in their own way. So this is important point. Now, after McDowell, another important judgment related to tax planning, etc., was Union of India versus Play World Electronics Private Limited. This is 1989 judgment in para 181. Apex Court has observed that McDowell tried to discourage colorable device, but court also observed that tax planning may be legitimate provided it is within framework of the law, and colorable device is not part of tax planning. Thereafter, another celebrated and landmark judgment is Union of India versus Azadi Bachao Andolan, 2004 judgment of Supreme Court, where Apex Court has observed that an act which is otherwise valid in law cannot be treated as non-est merely on the basis of some underlying motive supposedly resulting in some economic deterrent or prejudice to the national interest. So this has also confirmed that tax planning without any colorable device can be taken, and there is no harm in that. And in this judgment has followed the principle of IRC versus Duke of Westminster. This is the important landmark judgment. Then another landmark judgment on this point is CIT versus 1/4 share and stockbrokers Private Limited 2010 judgment, wherein Apex Court has viewed that with reference to dividend stripping transaction, it was observed that mere tax planning without any motive to evade taxes through colorable device is not frowned upon even by the judgment of Apex Court in McDowell case. So these are another important judgment, and the recent judgment on tax planning is Vodafone International Holdings BV versus Union of India. This is the landmark and recent judgment one, in which Apex Court has held that what is prohibited is tax evasion. Tax planning is not prohibited. Tax evasion through use of colorable device is certainly prohibited, and by resorting to dubious method and subterfuges means clever evasion or escapement dishonestly is prohibited. So genuine strategic tax planning is allowed, permitted, and there is no question mark on that. So this is the important aspects of tax planning, tax evasion, and tax avoidance. So revenue cannot be subject without a statute to support, and every taxpayer is entitled to arrange his affairs so that tax shall be as low as possible, and he is not bound to choose the pattern which replenish the treasury. So a taxpayer has his own way, revenue collection is another way. So tax planning is the legal. Tax planning could be through according to the provisions of tax law already written in the statute book. So accordingly we can do so. There is no harm in that, as decided in the landmark judgment of Vodafone International Holding BB versus Union of India 2012 judgment, another important judgment. Now we are moving to another important topic, which is the delegated legislation. So delegated legislation means sometimes the main legislature or principal legislatures enact the basic principle or basic law, and subordinate legislature given some time to work thereon, and accordingly they frame the rules such as Income Tax Act enacted by Parliament, and rules by CBDT or notification or circular being issued by CBDT. Similarly, under GST, CBIC is issuing certain notification or circulars or rule making powers under the CGST Act, like that. So it is not that the main act or parent act give power for rule making or delegated legislation or subordinate legislation. So if there is any conflict between the parent act and subordinate legislation, say for example if there is any provision in Income Tax Act and rule and both these provisions are contrary, then certainly the provision of act will prevail. So we must note thereof. Then there must be a check on delegated legislation. So delegated legislation must be within the power vested to the executives and not beyond that. Then there must be control checks by way of the notification issued or rule made must be led before both house of the Parliament, and at least some exposure. All these control mechanisms are there under the tax statute in the GST, as well as provision in the Income Tax Act section 296 of the old Income Tax Act 1961, and corresponding provision is section 534 in the Income Tax Act, where any rule made or circular etc. shall have exposure of Parliament, and if Parliament so decide, then the modified rule could be made applicable. If Parliament so suggest for any modification, we must take care of. And we have just discussed that if there is any conflict in the parent act, say Income Tax Act and income tax rules, then certainly the provision of Income Tax Act will prevail, because delegated legislation has limitations. Within that only they could make the law. The important point is that delegated legislation is subject to judicial review, and if they are ultra vires or beyond the power given, then such rules may be treated as ultra vires. So while framing rule, the provisions of the principal law, the provisions of constitutional law, the provisions of other statute, and the power conferred by way of delegations, all these must be taken care of. Otherwise the rule may be, or delegated legislation may be, or subordinate legislation may be treated as ultra vires and beyond power of the delegates. So these points must be taken care of. Then we are discussing The nature and effect of circular. Yes, this is very important point. We are going through so many circulars issued by various authorities such as CBDT or CBIC. So circular issued represents merely the understanding of a statutory provisions. They are to explain the law and to ensure fair enforcement of its provisions. They are not binding upon court. The task of interpretation of law is the exclusive domain of court, particularly the High Court and Supreme Court. Circulars, contrary to a statutory provisions, has no real existence in law. Under tax laws, imposition of tax consists of liability, quantification of liability, collection and recovery of taxes, and the government work through senior officers like possibility and CBIC, etc. So circular issued are executive in character and therefore cannot alter provision of act. They are binding on income tax authority. That is very important, but cannot enforce adversely against the SSC. SSC has all the powers in the statute, particularly the Income Tax Act 2025 has a specific provision related to the what are the duties, what are the powers related to the SSC. Circular cannot impose on taxpayer as a burden higher than what is mentioned in the Principal Act or such as what is mentioned in the Income Tax Act. So no more burden on the taxpayer through circulars. Circulars are external aids to construction. So these are the important points related to circulars. We have just discussed all the important aspects of jurisprudence of Income Tax Act 2025 as amended by Finance Act 2026 with reference to important judgments of apex court on various points time to time. I hope all of you are enjoying the videos and all of you are requested to comments on any material aspects related to the videos, and you are also requested to share with your friends so that all of you get benefits of the videos. You are also requested to subscribe the channel and share among friends. Thanks for watching. Thanks.